Welcome, everyone. Today we are diving into the fascinating world of the stock market, specifically focusing on trading. We'll explore what trading actually is, the different types of trading, the factors that influence it, and how the trading process works in the context of NEPSE.
Let's start with the absolute basics. What is trading? In the stock market, trading is the process of buying and selling shares over a short period. Traders analyze current price movements to plan their trades, making fast decisions based on technical analysis. This is very different from investing, where you might buy a stock and hold it for 5, 10, or even 20 years.
To put it simply, traders look at price charts, perform technical analysis, and base their short-term buying and selling decisions on those patterns. While other countries might have crypto or forex trading, in Nepal, those are illegal. Our only option is stock trading, buying and selling shares of publicly listed companies on NEPSE.
Now, let's look at the different approaches to trading. Generally, there are 4 main types: intraday trading, swing trading, positional trading, and scalping. Each has its own time frame and strategy, though not all are applicable or available in every market, like NEPSE.
For instance, intraday trading involves buying and selling a stock on the exact same day. Scalping is even faster, with trades happening in seconds or minutes. Currently, neither of these fast-paced trading styles is possible within the NEPSE system.
Swing trading, on the other hand, is very popular. In fact, more than 90% of traders in NEPSE use this method. Here, stocks are held for a few days up to several weeks. The main focus is technical analysis, usually using daily or weekly timeframes, but a basic understanding of fundamental analysis is also helpful. Then we have positional trading. This is more of a mid-term approach, where you buy and hold shares for weeks or even months. For positional trading, you really need a solid grasp of both fundamental and technical analysis to make informed decisions over that longer horizon.
What actually moves the needle in trading? Several key factors influence trading decisions and market prices. Understanding these elements is crucial for anticipating how a stock's price might behave in the near future. First and foremost is the market trend. You must understand if the overall market is moving up, going down, or moving sideways. This is called trend analysis, and it's arguably the most important factor to grasp. Next is technical analysis. Traders use specific chart patterns like the head and shoulders pattern, along with mathematical indicators such as RSI and MACD, to predict future price movements based on historical data. Volume is also critical. It shows how interested buyers and sellers are at the current market price. Finally, news and events, like company announcements, government policies, or global events, can have an instant and significant impact on a stock's price. So, how does this all work in practice within NEPSE? The market involves 2 main parties, buyers and sellers. All buying and selling happen through a broker account, specifically using the Trade Management System, or TMS. To get started, you access your broker's TMS via a web browser. You'll use the client code and password provided by your broker. Once you log in, you'll be taken to the main interface where the actual trading happens. Before you can buy any shares, you need to load collateral into your account. You typically transfer funds from your bank to a digital wallet like eSewa, IMEPay, or Kalti. In the TMS, you navigate to Fund Management and select Load Collateral. You choose your payment method, enter the amount and remarks, and then provide your wallet credentials and OTP. Once completed, your collateral is loaded and you are ready to trade. Now for the exciting part, placing an order. In the Order Management section, you'll find the Buy and Sell Order interface. This dashboard shows the current market depth, displaying the top buyers and sellers for a specific stock. On one side, you see the total buy orders. It shows exactly how many quantities are being requested at specific prices. On the other side, you see the sell orders. This gives you a clear picture of the current supply and demand. An important rule to remember, you can only place orders within a 2% range above or below the last traded price. The system clearly displays the highest and lowest prices you are allowed to enter for your buy or sell orders. To buy, you select the buy side, enter your quantity, and set your price, whether you want to buy immediately from a seller or set a lower target price. Once you submit, if a seller matches your price, the order executes. You can then track its status in the daily order book under completed. Moving right into the core mechanics, let us clearly define what trading actually entails. Trading involves the buying and selling of shares over a very short-term period. Traders rely heavily on analyzing current price movements against historical data, utilizing technical analysis to predict immediate market shifts and capture quick profits. On the flip side, investing is strictly a long-term strategy.
Here, the primary goal is to identify fundamentally strong companies and acquire their shares over an extended period. We are not looking at holding for a few weeks or months. Investors are looking at holding for 3, 5, or even 10 years to build lasting wealth.
The underlying mindset in investing is that if a fundamentally strong company performs well, its share price will naturally rise over time. Furthermore, these robust companies often distribute dividends, which compounds the investor's wealth-building efforts without the need for constant buying and selling in the market.
Now, let us break down the actual time commitment required for each approach. As an active trader, you must dedicate a minimum of 6 hours a day to the market. This includes about 4 hours actively monitoring the live market and at least 2 hours conducting thorough research to plan your daily trades. Conversely, investing demands far less daily time involvement. You do not need to be glued to the live market ticking away every single day. Instead, you can utilize your free time to research and select fundamentally strong companies, steadily investing your capital without disrupting your daily routine or full-time job.
Looking at the specific timeframes involved, trading is characterized by very short holding periods. Depending on settlement rules, like a T+3 system, a trader might buy shares today and sell them just 3 days later, a week later, or perhaps a month later. It is almost always a period of less than 1 year. By stark contrast, the investment timeframe spans several years. Investors construct a long-term plan, generally aiming to hold their positions anywhere from 3 to 5 years, or even stretching up to a 10-year horizon. They intentionally ride out the short-term noise to capture the true value of business growth over the decade.
Seriously, this brings us to a crucial differentiator, the risk level. Trading carries an exceptionally high level of risk. The market is highly unpredictable in the short term, where sudden company news, economic shifts, or political instability can cause instant, aggressive price reactions that might immediately go against your active position.
Because of these rapid psychological and news-driven impacts, traders must rely on strict risk management protocols. This means calculating exactly what percentage of risk is acceptable for a specific target percentage of profit, ensuring that one unpredictable market swing or bad trade does not wipe out their entire trading portfolio. Investing, while not entirely risk-free, carries comparatively lower risk. Short-term market dips and peaks do not significantly impact the overarching strategy. Long-term investors are mostly indifferent to daily price volatility, focusing instead on whether the company's core price is reliable and its long-term growth potential remains intact despite temporary setbacks. Finally, what do these two groups focus on daily? Traders are heavily focused on technical analysis. They spend their time studying chart patterns, utilizing various technical indicators, and closely monitoring breaking economic or company news to make rapid, informed decisions on immediate price movements. We will look at how this contrasts with fundamental analysis next. Moving right along from our previous discussion, let's look at exactly where traders and investors direct their attention. Traders are typically glued to 4 main technical analysis indicators. They also keep a very close eye on immediate company announcements and broader economic news to make rapid, informed decisions in the market. Investors, on the other hand, look at the underlying machinery. They focus heavily on a company's fundamental business model, the quality of the management team, operational expenses, and long-term future plans. They aren't looking at minute-by-minute charts, but rather the structural health of the business. Because their focuses are so different, the required skill sets vary wildly. Trading is all about fast decision-making. It demands intense discipline and a very specific type of patience. For a trader, patience doesn't mean holding a stock forever. It means waiting for the absolute perfect moment and the right setup before executing a buy order. Conversely, the investment side requires the patience to actually hold on to an asset through market turbulence. Investors need the technical skills to perform deep fundamental analysis, which means reading balance sheets and profit and loss statements, something we covered extensively in our last segment. Let's talk about what everyone wants to know, the returns. In trading, you can see incredibly fast returns, and expectations are usually quite high. But before even thinking about profits, a trader must have calculated their risk perfectly. Because we are buying and selling in the short term, the possibility of taking a loss is significantly higher. For investments, the returns are much more stable, but they require a significant amount of time to materialize. It is generally a safer approach with comparatively lower risk. You are trading the speed of your returns for a higher degree of safety and predictability over the years.
Now, let's dive into trading psychology, specifically the dangers of greed. Imagine you use technical analysis and buy a stock at 500, setting a clear target to sell at 600. The price hits 600, but suddenly you start thinking it might reach 7, 8, or even 900.
Because of that greed, you ignore your original plan and fail to sell at your target. Instead of climbing, the price plummets from 600 down to 480. You let the desire for just a little bit more erase a perfectly good calculated profit. This is how greed destroys a trading account.
On the opposite end of the spectrum is fear. Let's say you buy that same stock at 500 and sensibly place a stop-loss order at 480. The market starts experiencing a broader panic, and you see the price dipping. It hasn't hit your stop-loss yet, but the anxiety builds.
Overwhelmed by fear, you manually exit the trade early, taking a loss before the price ever touches 480. Almost immediately after, the price bounces back up. Your fear, rather than your strategy, controlled your actions. In trading, emotional reactions like this are incredibly destructive. This brings us to the core objectives of each approach. The primary objective of trading is figuring out how to make money in the short term. It relies entirely on looking at past price charts, understanding current trading ranges, and using technical analysis to predict the next immediate move. The main objective of investing, however, is building wealth over the long term. Investors do not care about today's or tomorrow's price movements. They are putting their money into the future of a company, looking to earn through sustained corporate growth and regular dividend payouts over decades.
To put it simply, trading is a short-term, high-risk game trying to capture daily price fluctuations, requiring you to be highly active in the market. Investing is a long-term journey where you make time your friend, believing in a company's growth to build wealth slowly without watching the screen every minute.
Once you understand these differences, you can decide your path. If you are a busy professional who cannot watch charts all day, consider midterm trading. This hybrid approach lets you look at a company's fundamentals for safety while still using price charts to find good entry points, which we will explore next.
Now that we have a solid understanding of what investment truly entails, you reach a critical decision point in your financial journey. You need to decide which path aligns best with your personal goals, risk tolerance, and lifestyle, active trading or long-term investing. This foundational choice dictates exactly how you will interact with the market moving forward.
But what if you have a demanding full-time job, run a business, or simply have a lot of family commitments? If you are a busy person, sitting in front of a screen all day analyzing tick data simply isn't feasible. For those with packed schedules, the author's recommendation leans heavily toward a specific, balanced strategy: midterm trading.
Midterm trading acts as the perfect sweet spot for busy individuals who still want active market participation. This approach requires you to synthesize two crucial elements. First, you must examine the fundamental health of the company to ensure quality. Second, you analyze the price charts to find the right entry. By combining both fundamentals and technicals, you create a highly robust trading plan.
The primary advantage of planning your trades based on this combined midterm approach is absolute time efficiency. Because you are looking at a slightly longer horizon and relying on solid underlying fundamentals, you simply do not need to constantly monitor the market tick by tick throughout the day. It completely frees up your schedule while still keeping your capital actively working for you.
That brings us to the end of this foundational section on market participation. Your major takeaway here is to always align your market approach with your actual lifestyle, utilizing midterm trading if you are short on daily screen time. Starting in the next module, we will shift our focus entirely to the mechanics of trading, beginning with the absolute basics of technical analysis.